Hello and welcome to the Astute Quarterly Market Update. My name is Paul Kelly and today I'm joined by Scott Osborne, our Chief Investment Officer. Hi Scott, I'm going to start by asking you a question relating to the Winter Olympics. Gold and silver seem to be taking the marketplace by storm. How are you playing this type of currency?
Yes, I mean, obviously it's on a good run. Unfortunately, a lot like Team GB, the funds don't have a lot of gold and silver in them at the moment. But what's driving performance? And I think the main thing actually from last year, we've really seen a step up in retail investor interest in gold, both gold and silver. You know, I've talked in previous videos about big secular themes that we weren't that confident around, and which is why we didn't put a gold position on in previous years. And to be fair, with hindsight, we know we were wrong on that. But that generally was built around this idea that post the Russian invasion of Ukraine, Western powers are kind of frozen Russian assets in clearinghouses in Europe, which Russia didn't expect to happen, so that they couldn't access those US dollars. Anyway, basically this had led to this reassessment by big global powers. How much of my money do I want to park in US dollars or US treasuries, US bonds? And what if I don't want money to be there because it could be, taken away from me? Should I choose to invade some country or other? What other alternatives do I have? And really, the only other alternative is gold. And so, even since the Russian invasion of Ukraine, the last 3 years, we've seen bigger reserve balances. So that is basically just, at the country level, your savings account, how much you spread that savings account around different assets in different countries. People have been moving away from US dollar assets into gold. And that was the big secular theme that's basically increased the demand for gold in the global economy, and thus have been applying general upwards pressure on the gold price for years and years. However, that sort of nicely rising gold price, which has been very beneficial for lots of people, accelerated very quickly last year. And we're pretty confident just from looking at flows into ETFs and so on, so different investment products that retail investors can buy, that the back end of last year, which is where most of this recent gold rally was mostly driven by retail investor uptake. And it really just managed to cut through to the general populace. Gold is a very easy asset to buy. It has all these kind of emotional attachments to it. People feel confident in what it is and what it does for them. And that drove this huge rally. I mean, I think in the last 12 months, gold's up over 50%. And that's even with the recent drops, which we saw post sort of Fed announcements in the US at the end of January. But all that being said, it's, as an investment in the portfolios, yes, obviously we're wrong not to own gold because it's done so well. But I didn't have confidence in that central bank secular theme to continue. I have no insight in the decisions of central banks. And we definitely don't invest in momentum-led sort of retail trades. That's just not, long-term investing. So whilst it's done very well at this point in time, it's very volatile, and it's not something that we'd really be interested in. I think a lot of the typical things people say about gold, about being a risk hedge and so on and so forth, may not be true, just because of this level of momentum that's in the asset at the moment. And so for us, as long-term investors, it's best avoided. Although we know lots of people have, attachments to gold, and like I said, there's been a lot of retail trade in that space.
So Scott, there's been quite a lot of commentary about the devaluation of the dollar. Can you tell me how that's impacted a UK portfolio, please?
Yes. So, as I was talking about gold there, that's the dollar debasement. So the devaluation of the dollar is the flip side of that trade, basically. And you've seen people worry about dollar assets, and that could be US government bonds and hard US dollar currency, as it was with gold. But it's also about US companies and how much, global portfolios have exposure to the US, given this concentration in AI and talk of a bubble, et cetera, et cetera. And really what you've seen is that most people, regardless of kind of the type of portfolio manager, whether they run funds like me, whether a big pension fund, a sovereign wealth fund, or just, your average sort of do-it-at-home investor, most people have been overweight US assets, at least to the extent versus history. And so when those risks have emerged, it's been a very easy trade, given how well the US has done, to kind of rebalance your portfolio at the very least. So slice the top off the gains that you've had in the US, and or indeed go further and start reducing your allocation to US assets. And that was a kind of general broad trend last year. It's one of the reasons why the US markets didn't do quite so well as other global markets, because the flow moved out of the US and into other areas. But generally, I think it was kind of overdone as an idea that, it's the end of the dollar debasement, et cetera, et cetera. I think it was more of just a gentle rebalancing. Now, your point about UK investors, obviously we have to be cautious when we invest overseas, that we are essentially always going to bring those investments back and convert them to sterling. We are sterling investors, and we spend our money in the shops in pounds. So if we invest in the US and a US company does very well, say it's up 10%, but the dollar is down 5%, really that return is only worth 5% to us. So we do a reasonable degree of hedging across the portfolio, and that helps offset that risk from currency moves. And that's not just the dollar, that could be the yen, emerging market currencies, whether it's renminbi or euro or whatever. And that's just sensible portfolio management. We don't play FX as a source of return. So we're not taking views on whether the dollar is strong, weak, whether we can make money by trading this currency or that currency, because ultimately we believe over time that just all offsets itself anyway. Sometimes there are opportunities there where you see clear mismatches, but the market is very efficient at correcting those. And that's why traditionally the biggest driver of currency movements has just been interest rates, because obviously if I borrow money in Japan for 0 interest, I convert it to dollars and I can put it on account in a US bank account and earn 3%. That would be free money at the point that I took it back to my yen, if the currency didn't adjust to account for that, and the currency does. So that still operates fine. I think we just had this one leg of kind of rebalancing, readjusting based on recent trends. Having said all that, there is clearly growing doubt about the reliability of the US as a global sort of partner in any way. Obviously the Trump, even post-Trump administration, what is the relationship with the US like? Again, back to reserve balances, how much of our assets do we want to keep in the US, and so on and so forth. And I do think that could continue to place downward pressure on the US dollar. But I don't think that thematic, unless there is another sort of round of craziness, let's call it, in the US on US foreign policy or whatever, I don't think that would be strong enough to outweigh the more fundamental drivers of FX moves, which is basically interest rates and more kind of boring market stuff. So yeah, it is important. It's a risk that we manage within the portfolios. It does have impacts for sort of perception and market sentiment and so forth. But ultimately, it's not something that we look to take advantage of. It's something that we try and completely hedge out of the portfolio, so we're not exposed to, shocks one way or the other.
Okay, so there's been a lot of commentary on AI and the influence that AI is having on the future developments of US stocks especially. Can you talk to me a little bit about that, please?
Yeah, I mean, obviously this has been an ongoing trend for a while. I do think there has been a change more recently, in the sense that we've started seeing the areas that AI is disrupting, rather than just piling into AI on the promise that it's going to be great. And this goes to kind of one of the fundamental questions about the real value in this AI trade, which is, okay, if it's a net gain for everybody, if AI just massively increases our productivity, then we should see winners out there in the market who are taking AI technology and applying it to make their businesses better. The other way that this can play out is obviously that the AI technology can disrupt and displace businesses. It can take other people's lunches away from them, and then you get more of a case of winners and losers, right? And I think more recently, it's been the latter. So we've seen a few examples of products launched, particularly Anthropic's Claude did a sort of legal services one. We saw lots of professional services companies take a big hit to their valuation, because it was the idea that actually this product's so good it could seriously hit the revenues of some of these businesses, very entrenched businesses, big global players in these markets, that might lose market share now just because of this AI. And that's a very different spin on the kind of cornucopian view of, okay, this is good for everyone, everything should go up because of AI. And we've always thought it's more nuanced than that, and I also don't think it's as clear cut as this product's so good it will replace these companies. There's obviously middle ground in there, but it's interesting that the market's moving in this direction and being slightly more considered about how that AI sort of diffusion through the economy occurs, and whether there's actually winners and losers in that, as opposed to just everybody being a winner. I think asset managers has been a recent one as well. St. James's Place recently lost a big chunk of its value because there's this view that some of their services could be replaced by AI. So I think we are in a different phase, and it will be interesting over the course of this year how the markets react to new products as they're launched from these AI companies. And they need to do that to justify their own valuations, but will that in turn affect valuations elsewhere in the market? That's not clear, and that's where the sort of debate will be and the volatility will be over the course of this year. But I do think we've moved into a slightly different phase of this technological cycle, as it were, as it moves through the economy. Yeah.
Okay, and finally, Scott, would you mind talking to me as we move into 2026, how you have the portfolio positioned?
Yes, so I mean it's always a good time at the start of the year to kind of step back and take a big overview. If I give you the sort of 30,000 view on the portfolios, is essentially we are, for the last couple of years, we've been cautiously optimistic or more optimistic than the market. I'd say at this point we are just neutral. So that relatively we've become slightly more pessimistic, but we're not expecting anything bad to happen necessarily. We just think everyone else is a bit more optimistic than we are. And what that means in terms of actual practical positioning is that we're kind of neutral on the risk assets. So in equities, our positioning is basically back to where it would be if I wasn't going to touch the portfolios for the next 10 years. That's kind of, I'd have this level of equity, which basically reflects we don't know what's going to happen and we don't have a strong view either way. It could be a really good year. It could be 40% plus year, sort of the end of the dot-com bubble type blow-off where you get really high. It could also be a down 20% year just as easily. And in that uncertain environment, it makes sense to us to just kind of be as neutral as we can be. Within that positioning, we are underweight the areas where we see more risk. So we're underweight US large caps, for example. We're overweight some of the areas where we continue to see value, regardless of the sort of fundamentals, relative to the outlook might not be that good, but the price we pay for some of these assets is so cheap it's worth it. Examples of that might be UK mid caps, for example. And some structural growers as well that we still like emerging markets. It actually did really well last year. We still see lots of reasons why you can be positive in that space over reasonable time horizons. The other area where it's slightly different depending on the fund risk level is fixed income and alternatives. And I talked in previous videos, most of the work we did last year was around diversification and trying to find assets that give us reliable income or reliable level of returns to navigate this level of market uncertainty. In the lower risk portfolios, we're still overweight bonds. We still very much like fixed income. We like the reliability. We think the fact that you can get paid 5% by the UK government just to own the debt is still a very good rate of return. And that's why we're overweight bonds in the lower risk mandates. That level of return, however, is not enough for a higher risk investor. If we need to compound returns at the levels higher risk sort of needs, it needs to be more than 5%. And so we've had to take steps to sort of find additional levels of yield for those portfolios. And most of that we've found in alternatives rather than in bonds. So we're overweight alts in our growth fund, for example. And again, a few sort of examples of what we have there. We have investment trusts where they're invested in infrastructure assets with nice reliable cash flows, physical assets that we could go kick with our feet and we know that's going to be there even in the event of a crash, but that also gives us a good level of income, and that income is enough to compound at the rate we need it to. And also some structured products, which I think I talked about in the last video. Basically market trades where, because of the range of returns, because of the level of volatility out there, we can swap the chance of really high market upside. I'm willing to give that up. I don't need to chase that market higher as long as the fixed level of return I'm getting is sufficient. And volatility has been so much weaker. We've been finding products like that. So I can get double-digit returns on a structured product, with reasonable degree of confidence in getting that return, even if I have to give up whatever the market gives me this year. And that's the kind of stuff that we like because it provides reasonable security throughout this year, and it also pays as income over the course of the year, which means I've got money coming back into the funds to put to work over the course of the year, giving myself good decisions to make in the future and the ability to react to things as and when they happen. And that feels like, the future me will thank me for doing that when and if we know things will happen over the course of the year. I'll have liquidity in the fund to put to work as and where we see the opportunities. So that's our kind of high level view. We're pretty much neutral. There's still areas we like, there's still areas we don't like. We actually think the setup's quite good for returns in nominal terms, but there's definitely going to be the same level of uncertainty and volatility we've seen in recent years. Midterms, Trump is still around, we've seen it all in the UK. That stuff's all still out there. So it's just navigating those as and when they come. And we think the portfolios is pretty well set up to be able for us to get through that.
Well, that's all we've got time for today. Please contact your normal financial planner at Astute. And if you are new to Astute, follow the link below for further details. Thank you very much.